Somebody with a lot of money traded Carvana stock, ticker symbol CVNA, today, February 15, and the stock reports earnings next week, February 22nd. So, does somebody know something? Because this is a very unusual trade before earnings. So in this video, we will analyze this trade to find out, are they bullish or are they bearish? And then set up a trade based on this result. If this is the first time you're on our channel, we analyze the trades of wealthy investors to find out which stocks they are trading and how they are trading, bullish or bearish, so that we can set up trades to make money, because we know the rich are getting richer. If you want more information on our analyses work and the stocks that we trade, I'll put a link at the top here where you can get more information. And so without further ado, let's get to Carvana. Options time and sales tape, 21,750 contracts. These are traded at 12:30 p.m., expiring May 17, 2024, 45 strike calls and the 70 strike calls. We can see the price that they paid and what they sold for. We believe they paid $17.60 here, and then they sold for $7.52, which means each of their trades cost $1,008. And since they did 21,750 contracts, this trade required $21.9 million. So quite a significant trade before earnings. We can see for the May 17th here on the option chain, the 45 strike calls, volume 21,700, much greater than the open interest, and the 70 strike call as well, 21,800, greater than the open interest. So we know that both of these strike prices are opening trades. And as we mentioned, they were buying the 45 strike calls and selling the 70 strike calls. And they were paying 1,008 per trade. So this is what their trade looks like. They are risking 1,008. You can see here, if the stock goes down, they lose. It's a negative. If it goes up, they could make 1,492. Okay. You can see that this is clearly a bullish long trade with a positive delta. Okay. If it was a bearish, it would be a negative delta. And notice that this is a positive theta, so there is no time decay, and they also have a negative vega, which is a good for earnings, because after earnings, volatility will go down. So this helps their trade out, okay, because of the implied volatility goes down after earnings. So how are we going to trade this? We know now that we should go bullish, right? Because this trader is doing that for Carvana. And what we want to do is something shorter term, and also that does not cost $1,008. Okay, we want to position size in smaller quantities. So what we did for the February 23rd, which is the day after earnings, we picked the 70 strike calls and we sold 2 for each of our trades. We bought the 67 strike call and the 71 strike call. And so when we analyze this trade, you can see here, you can see that our trade only costs just $46. So that is the minimum amount, and we can decide how much we want to risk. One of these trades is risking $46. So if we want to risk more to make more, we can add more contracts by position sizing. Okay. And so this is how we're able to manage our risk for earnings, because earnings can be risky. You can see that potentially we could make 154, which is about 300%. So this risk to reward ratio here is 1 to 3. So because this is earnings, keep in mind it is always risky to trade earnings. So if you are not prepared to manage the risk, then consider not trading earnings. Okay. And go to our website where we share trade ideas on other stocks that the wealthy investors are trading when it's not earnings, because these are higher probability of profit trades. And let us know in the comments below what you think about this Carvana trade. Is it insider trading? What do you think? And please smash the like button, subscribe if you haven't, and as usual, please have a wonderful day. Take care.